our technical third case here deals with a really neat code section, I think,
That's
1244.
that's why we picked it.
What do we got going on here?
All right. So the next three cases, well, there's a case, rulings case. There are public service announcement. That's why we chose them, right? This case in particular, is there anything really illuminating in the case itself? Not really, but what we want to do is alert listeners to the existence of 1244 and make them understand, when we should be thinking about it proactively. And then we're going to get into 1202, we're going to get into 1341, three provisions that I think the main hurdle to them is knowing they exist, right? Okay, so Damien, right? We've all got that family member somewhere on one side of the family or the other that fancies themselves an entrepreneur and wants to keep starting up businesses, and then they come knocking on your door for an investment.
Sure do.
We know it's going to fail. It's always failed. It's going to continue to fail, but we still have to buck up and make an investment. So the question is, right, there's two ways to make an investment in this doomed business. We can make a loan or we can invest some equity. And, in a perfect world, we might want to make a loan so we can collect some interest and what have you and take back collateral. But we know we're not getting paid interest because we know we're not even getting paid principal. Again, we know that basically we're making a charitable contribution here because this thing's going to fail. And obviously I'm exaggerating, but I'm trying to make a point. Trying to make a point is if you're worried that an investment is going to go belly up, is there an advantage to doing it one way or the other, debt versus equity? Well, let's say we do this thing as debt, right? We loan an amount to this fledgling C or S corporation, whichever of the two it ends up being, and it goes bad and we don't get our debt back. Well, the treatment there is under Section 166, right? Bad debt deduction. But the crux is it is extremely difficult for an individual to claim a business bad debt. And the reason you want a business bad debt is an ordinary deduction, whereas a non-business bad debt under 166 is a cap loss. And we always want ordinary losses more than cap losses, right? I mean, that's just how it goes. So as an individual, the only way you can really argue that you have a business bad debt is if the loan is made as part of your business or you are in the business of making loans. So if you just make a loan to your cousin's startup company, you're not getting a business bad debt. Now, there is a case called Generes with a G, where if you make a loan to a company that is your employer and the loan is small relative to the size of your salary, you can argue, hey, I'm making that loan to protect my business as an employee, and I can actually take a business bad debt. And the funny thing is, people used to fight and fight and fight to get this business bad debt. We had cases like Generes and Trent. Oh, I want this business bad debt as an employee. And the funny thing about where the law sits now is if you fought for that and got that business bad debt, you'd actually be worse off because it would be an unreimbursed employee expense, other miscellaneous itemized deduction, gone by virtue of Section 67G until 2026. Yep. So you're actually better off with a capital loss right now. So long story short, bad debt as an individual, you loan it to your cousin's startup company, it goes bad, you're taking a cap loss, okay? Now, what if instead you put equity in? Well, if the equity goes worthless, that's governed by Section 165. And what 165 does is say if an investment goes worthless, it's deemed to have been sold on the last day of the tax year. Now, why is that critical? Because in order to have capital gain or capital loss, you got to have two things. You got to have a sale or exchange of a capital asset. And so if you hold stock in your cousin's company, we know it's a capital asset, but if it goes worthless, there's no sale or exchange. You didn't get any value. So what 165 does is it forces sale or exchange treatment on us by saying worthless stock is treated as if it's sold the last day of the year. And so we get stuck with capital loss treatment anyway, right? Now, we don't probably need to go down this path, but it is interesting to note the proposed legislation in the reconciliation bill would actually do two things. It would move that deemed date of sale for worthlessness from the last day of the tax year to whatever day it was actually identified as worthless, which I have no idea how you do. But the second thing it would do is try to reverse Rev Ruling 93-80, which is the Rev Ruling that says if you walk away from a partnership interest and the partnership has no liabilities and you abandon it, even if it's not worthless, if you abandon it, you can get an ordinary loss. This new legislation would say abandonment will now be treated as akin to worthlessness. And so since worthlessness is a deemed sale or exchange, now you won't be able to get any ordinary losses if you walk away from a partnership because you're going to get this forced sale or exchange treatment if this legislation goes through, so you'll get a capital loss. Okay, none of that has anything to do with what we're talking about here. So at this point, right, at this point, whether we make a loan to our cousin's company or put in equity, if it goes bad, we're getting a capital loss, right? Because if it goes worthless, we're treated as if we sold it on the last day of the year. That's capital loss treatment. But if you're aware of Section 1244, which, as you described, is a neat little provision, then the game changes, but only if you're aware of it. So what happened here in the Ushio case? And then we'll talk 1244. Really simple set of facts, clumsy case, way too many missing pieces for my liking, but you got a guy who forms a C corporation in 2009. And I don't know how this can be hard to establish, but he claims he puts 50 grand in for 50 shares of common stock. That's it, that's all. But yet, the whole point of this corporation is it was supposed to invest in an LLC, and it was supposed to put, over $1 million into this LLC. Well, where's that money coming from? Presumably it was going to come from this taxpayer, the shareholder. So he had like this schedule of amounts he contributed. In total, it was over $1 million, but he claimed that part of it hadn't been contributed. All of this becomes relevant in just a moment. So the company's supposed to invest in an LLC, never does anything, never generates a dollar of revenue, nothing ever happens with it, and he dissolves it in 2013. And so he ends up being audited for other issues. And the IRS says, you should take a capital loss for this bad investment that you made. And then someone must have alerted him to the presence of 1244 because he says, wait, I'm going to take $50,000 of ordinary loss. Okay, now it's time. What is 1244, right? Well, what 1244 is it's a provision that says, and I want everyone to think of this as a companion provision to 1202 that we're going to talk about next, it says if you invest in certain qualified kind of small business stock, and you end up selling it for a loss or walking away from it in an abandoned, like a worthlessness situation like this where you get capital loss treatment, we're going to go ahead and throw you a bone. And we are going to let you take up to $50,000 of the loss as ordinary, or if you're married, $100,000. So he comes in and says, I'm going to take a $50,000 ordinary loss. I can't for the life of me, Damien, figure out why it's only 50. Is he arguing he only put in 50? Because he's married, it's a joint return, so I can't figure out why it wouldn't have been 100, because it sounds like he certainly put in more than that. But
sounds like maybe when he was at the country club, at the golf course, the guy only told him about the 50,000. He didn't tell him about the 100,000.
That's it. That's it. They didn't read the parenthetical there, right?
Yeah. Got to read the footnote.
So anyway, he takes the position he can use this 1244. So 1244. To have this qualified investment, you got to meet a couple of requirements. Number one, it can be a C or an S corporation, and that's different than 1202. We'll talk about 1202. That's very specific to C corporations. Here you can have a C or S, right? You have to acquire the stock at original issuance, which is another common theme we'll see in 1202. It just means that Damien's a shareholder. I can't buy Damien's shares. I got to get my stock directly from the corporation in exchange for cash or property, whatever it may be, okay? Then we have this rule that for a 5-year window, they don't want more than 50% of your gross receipts to be attributable to passive investments like rent and royalties and interest and dividends, okay? Now that rule is ignored if you run a loss every year. And I know I'm getting too much into the weeds, but in the committee reports, there's this overarching concept that you do have to prove you're an operating business. You're actually doing something. And then the last critical piece is it's for small businesses. And the way they define small businesses here is they say the cumulative amount of cash and property that's been put in by the time you receive your stock was under $1 million. So that's small. We're talking small companies, right? Very different than what we're going to talk about in 1202. So this guy claimed that his corporation he formed was a 1244 corp, under $1 million of total capital that went in and, met all the different requirements. The court shut him down pretty quick, Damien, for two reasons. Number one, and again, I don't know why this is hard to establish, it was not clear to the court at all how much cash he had originally put into this thing. Was it over $1 million? Was it not over $1 million? They said he could not clearly establish and document that this met that $1 million standard under 1244. But even if he had satisfied that, there is this overarching concept in the committee report that says you got to be an operating company. And this company never had a penny, not a single penny of receipts in its, 4-year run. So they shut him down and said, you don't get 1244 here because you can't establish you were a small corporation. You can't establish that you were an operating company. And so we're shutting you down. But for our listeners here today, this is important, right? If we're going to loan or if we're going to give money to our cousin's startup business, and in the back of your mind, you're like, this is a donation because it ain't going to go well. You may, be interested in doing that as equity rather than a debt, just so that you can claim an ordinary 1244 loss if your worst fears are realized and this thing goes belly up.
Yeah, but mind the details, right? I mean, certainly, and making sure that it actually meets the definition there. Got to read the code section in the committee report for sure.
But that's awareness, man. Like, you know what I mean? 1244 is about awareness. It's so easy to slip through the cracks and not even know it's out there. And then next thing you know, you're dropping a capital loss onto a client's return and you don't realize it's a 1244 company.